Ever felt a bit lost in the stock market jungle? It's like picking a movie on Netflix. So many options, and you're getting bummed about what's the best choice for movie night. Investing in the stock market can be challenging and thrilling. With so many companies to choose from and constantly changing market conditions, it can be hard to determine which stocks are a good investment. This is where understanding intrinsic value comes in. Intrinsic value is the true value of a company or a stock, and it can help investors make informed decisions about their investments. Welcome to Financial Literacy. Here, we are dedicated and passionate about bringing you nothing but honest and straightforward facts about your money. We will help you take control of your finances and get you to the next level. Beginners or experienced, this is your one-stop shop for all things financial literacy. Spoiler alert, in this video, there will be math. But hey, don't panic, it's just basic elementary math. So buckle your seatbelts because we are going on a trip to financial heaven. So, are you ready for this? Cause I'm going to be real with you, this is enough to scramble your brain. And you thought algebra was complicated, but I want to commend you because here you are, willingly stepping into the math because of one reason: to make smarter investment decisions. So if you're ready, then let's start the video. What is intrinsic value? The simplest answer would be that it's the real value of a company's stock as opposed to the momentary market price tag it's slapped with. It is what a rational investor with all the knowledge in the world would pay for the stock. Imagine using a barcode scanner while shopping that not only displays the price of an item, but also its true value. This will certainly help you make more informed purchasing decisions. Perhaps you're wondering why intrinsic value is even important. As an investor in the stock market, you don't just buy low and sell high. No, that is only for babies. It's about buying a share of a business. And just like you wouldn't want to pay $500 for a pair of jeans that's worth $50, you wouldn't want to overpay for a stock either. So, it separates the smarties from the amateurs, the wheat from the chaff, and the good deals from the bad deals. This means the key to becoming one of the wise ones is to calculate intrinsic worth. Pretty exciting, isn't it? Well, here's a question for you. Are you ready for some math equations? Introduction to Discounted Cash Flow Analysis. Before anything else, let me introduce you to something we call Discounted Cash Flow Analysis. Sounds intimidating, right? It sounds like something you'll just pass on. But really, it's just a dressed-up way of saying how much money a company is putting in its piggy bank. And who doesn't love a good old piggy bank? So let me explain further. Cash flow is the ka-ching sound you hear when a business makes money. It is the lifeblood of any company. No cash flow, no bustling business. Imagine a heart pumping out blood. Pretty crucial, right? Well, cash flow is to a company what blood is to the heart. Let's move on to the theoretical aspect. To draw out a company's future, discounted cash flow is similar to looking into a crystal ball. It involves estimating the amount of the lovely green stuff that a business will probably produce in the years to come. Finding the present value of future cash flows is a key component of DCF. It resembles time travel a bit, but without the bizarre machinery or terrifying dinosaurs. To calculate the present value of future money, we adjust it using a discount rate. The more distant the cash flow, the less it's worth today. Why? Because a bird in the hand is worth two in the bush, my friend. Pro tip, try not to snooze off while doing your DCF calculations. Trust me, it's not half as tough as it sounds. The art of estimating future cash flow. Okay, say you have a crystal ball that will see through the future of your cash flows. It can be a challenging task, you know. But then, who said estimating future cash flow was going to be a child's play? It's all about those company growth prospects, you see. Those little percentages have the power to make or break your fortune. Now don't go biting your nails off, and you don't need to be a psychic. You just need to crack the code, delve into the sales data, revenue predictions, market trends, yada yada yada. Loan figures can often be as intimidating as flickering red eyes in the dark. But what if those numbers represent interesting equations like CF plus GP plus a little bit of luck equals bingo? A word of caution. Making educated decisions is more important than depending just on your gut. You'll find yourself making educated guesses when you carefully compute the expected growth rate and cash flow inputs. Think of them like precisely directed darts that frequently hit the target in the dark. Suddenly, analyzing the stock market feels more like an exhilarating detective pursuit, doesn't it? The game is on, my fellow Sherlock. Intrinsic value calculation using price to earnings ratio. Now, let me have a quick drum roll, please. Introducing the price to earnings ratio, our trusty sidekick in the realm of intrinsic value estimation. Get your calculators ready and let's indulge in a little financial acrobatics with our friend Robo Basketball. So, Robo Basketball has been bouncing up on us for a while with an earning per share of $3.30. Good for them! We're predicting a growth rate of 12.5% over the next 5 years. Ambitious, but plausible. The stock at present has a PE multiple of 35.5. It might seem hefty, but bear with me. Are you still with me? I hope you didn't doze off just by hearing some numbers. Let's go back. In this financial jamboree, the calculated intrinsic value would be an earning per share of $3.30 multiplied by the quantity of 1 plus 0.125, then multiplied by the PE multiple of 35.5, which is equal to, drumroll please, $131.79 per share. Fancy, huh? You can now break out into a little victory dance. The intrinsic value seems fair. A word of caution though, don't let these numbers get to your head. They can be a little feisty. And just like that, we've conquered the PE ratio method. Stay tuned for more financial jazz. Remember, the stock market, it's not just business, it's full-on showbiz. Estimating intrinsic value through asset-based valuation. Okay everyone, let's now explore the captivating realm of asset-based valuation to calculate intrinsic value, often regarded as the foundation of finance. Here's the key point. Intrinsic value is the result of subtracting liabilities from assets. Think of it like a diet. You aim for fewer liabilities and plenty of assets. And of course, we have our friend Robo Basketball. Now, imagine that you are standing in a field of financial data and you spot Robo Basketball's balance sheet in the distance. Whoa! Flashy assets and much smaller liabilities. In financial lingo, we'd say, we've got a winner. But wait, how do we quantify this? Listen closely. Just tally up the company's assets, both tangible, like machinery and real estate, and intangible, like brand value and patents. Subtract the company's liabilities and boom, you have your intrinsic value. Consider it as a treasure hunt where you're trying to find the real worth of a company, minus its debt. It's an interstellar journey kind of thing, except instead of stars, you're navigating through balance sheets. Fun, right? So, let's review again. Why is it important to morph into a math wizard when pondering stock investments and intrinsic value? Because being able to accurately estimate a company's intrinsic value enables you to separate the true gems from the overhyped duds. It's all about maximizing those returns and transforming into a true Warren Buffett in the making. Remember, nothing beats the satisfaction of identifying undervalued stocks with your numerically inclined brainpower and then watching them skyrocket. After all, they say numbers don't lie, right? Thank you for watching. If you like this video, please don't forget to give a thumbs up, comment, and hit that notification bell so you don't miss out on our following videos.